Money Monday is sponsored by Husky Financial.
Are you on track to retire? Well, it's never too soon or too late to start socking away money and potentially growing your nest egg. Let's welcome back on our Money Monday sponsor, Stephen Husky, certified financial advisor and founder of Husky Financial Group. Great to have you back.
Good morning.
So we're going to be talking about different investment products for retirement. And there's a lot of them that we've heard rattled off time and time again. IRAs, 401ks, Social Security. So why don't we go through some of the top ones and how one should approach these products. Let's start with IRAs.
Okay.
Describe for our audience what an IRA is.
So there are traditional, which are pre-tax dollars going towards this account, and they're growing tax deferred. When you take the money out in retirement, you're paying tax at that time. You know, it could be in a lower or a higher tax bracket at that point. But you also have Roth IRAs, which are putting in after-tax dollars. They grow tax deferred. You take that money out in retirement, tax-free income at that particular point in time.
Tax-free. So that's the operative. And so that makes it an attractive option for people who are starting to sock away that money earlier or later?
I think it's going to be better to put your money, if you're eligible for that, based on your income, into a Roth IRA now. We're in a lower tax environment. According to history, back in 1916, when the 16th Amendment was passed, income taxes were put into place at that point in time. Even in 1945, after World War II, there's a 94% marginal high tax rate at that point in time. So in relation to that, we're in very low tax environments, and we anticipate, experts do anyway, of taxes increasing over time. So why not pay taxes today, and later on, maybe 30, 40 years from now when you're ready to retire, then you can take that money on a tax-free basis.
Oh, that's interesting. And do we see growth with an IRA or Roth IRA in those years? I mean, something that's actually substantial?
Yeah, typically it depends on what you invest in. You know, you can put mutual funds in there, stocks, cash, whatever it is that you need. But with that growth, and because you're not paying taxes each year on that growth, you're going to have tax-deferred money continuing to grow, and it really compounds over time. So compound interest is a very powerful tool to use.
Yes, it is. Compound interest, it's a beautiful thing, isn't it?
It is, yes.
Let's talk about 401ks. So a lot of employers, they do offer their employees 401ks. Is this something that is wise for one to invest in?
I would anticipate that you should be putting your money into a 401k at least up to the match, and then any extra money you can put towards some non-qualified assets you can invest in on yourself. You do have limited investment choices in a 401k, but if they provide a match, it would be wise to definitely put your money in there up to the match and then get that match as well from your employer.
Okay, let's talk about Social Security.
It's the largest annuity.
Yes, exactly. So this is something that they've been talking about for years, that come our generation, we're not going to be able to take advantage of Social Security. That hasn't exactly happened just yet,
right.
But it's still that safety net. It's a fixed income for some people right now, but what are we looking at in terms of when to take out the Social Security?
Right. It depends on when you want to take it. You're eligible for it at 62. You can wait all the way up until age 70 to take it for 140% of benefit at that time. The retirement age has been pushed back from 65 to 67, so that's when you get 100% of the benefit at age 67. So if you have other assets you can draw from and wait to take Social Security, it may be in your favor to do so.
Okay, so you say the earliest you can take it out is when?
62.
62,
Correct,
and the latest is?
Age 70.
Age 70, and then if you don't do it voluntarily, do they just start sending you checks?
You're forced to do it.
You're forced to do it.
Yeah.
You're forced to take the money, people. All right. And real quick, annuities. So tell us about annuities, and in terms of adding those to your portfolio, is that something that's recommended? And this is something, again, that people who have not socked away money early on in their life, is it a good idea to start doing it now if they're a little bit older?
I would say, up to maybe 30% of your portfolio can provide you with some guaranteed income sources. Less than 31%, according to personalcapital.com, have pensions at work. So annuities are great tools to use to have those guaranteed income sources, and there's different options for covering just you or you and your spouse. So maybe talking with a financial advisor can help you choose the best option for you and your family.
Okay, and can we just touch on briefly what's happening in the current economic climate in terms of inflation, and people are seeing dips in their portfolios now. So you said that you're getting a couple of emails here and there, but overall, are people anticipating this to happen and then for life to carry on as it was before.
Well, that's one of the main economic risks of retiring right around now when the market is down. When you start drawing income from that portfolio, you're essentially locking in those losses. It's called the sequence of returns risk. So making sure that you're taking from an area of your portfolio that maybe isn't experiencing those types of losses. The guaranteed income sources are great if you have cash socked away. If you have a bond portfolio, which is seeing some dips, you probably don't want to draw from that right now, but having some guaranteed income sources, whether that's annuities or cash value life insurance or guaranteed corporate bonds, you can take from those as the market is down, and then when the market goes back up, maybe start looking at other sources of income.
If someone is at retirement age and they were really anticipating this to take place at this time, is it wise to wait it out, maybe work another year, 2 years, if you can?
It's certainly an option. It's all really about how you adjust to all the economic factors out there. So that's why we really like at Husky Financial the 3-bucket approach, having a guaranteed income source bucket, a bucket of true liquidity, which is essentially having cash, bonds, or cash value life insurance on the side of your portfolio, which is not relied upon for income, which protects those assets that are invested in the market. You can draw from that true liquidity source during down times like now, so that you're not having to experience those losses.
And what's that third bucket?
It could be anything really, so it depends if it's cash, bonds, cash value life insurance, something that's not counted on for income that you can draw from during those downtimes.
Preparing for that rainy day.
Exactly.
You just never know what's going to happen. Stephen Husky, thank you so much. Always a pleasure. We're back after this.